Hello, welcome to this revision class recording on the module FIN3701. In this revision class, I'm going to be taking you through the May-June 2020 paper. Be sure to also go through my revision classes where I touch on the October-November 2019 paper and also the May-June 2019 paper. So this paper was a 3-hour paper and it was made up of 4 questions. It was made up of 4 questions. The first question was on capital budgeting. The second question was on cost of capital. The third question was on capital structures, comparing different capital structures. And the last question involved the investment opportunity schedule and also the residual theory of dividends. As always, I would advise you in the exam to make sure that you don't get stuck on any question. If you read through a question and you find you're not familiar with what the question is asking, you shouldn't panic. You should just leave that question, move on to another question. Answer what you know first. Make sure you get easy marks on the things that you know. And then when you're done with the more straightforward marks, then you can come back to the harder parts of the paper. So please don't get bogged down or stuck on any one particular question. Always try to manage your time right in the exam. And for example, if you're dealing with a 70-mark paper, for example, and you've got a 23-mark question, what you can do, you can say 23 divided by 70, and then you can multiply that by 180 minutes, and then you'll see here I get 59 minutes. So it means for this 23-mark question, if it's a paper out of 70 marks, you should spend at least a maximum of an hour on question 1. And then for question 2, maybe you can even do that at the start of the exam. This is a 14-mark question. You can say 14 divided by 70 multiplied by 1 hour, 80 minutes. Sorry, 180 minutes, which is 3 hours, and then it's 44 minutes. So for question 2, it should be 44 minutes at most. The 19-mark question, 19 divided by 70 times 180, it should be about 48 minutes as well. And then the final question, which is 14 marks divided by 70 times 180, should be 35 minutes. So you might even finish these questions earlier, but it's just a guide. And then you can write the number of minutes that you should spend on each question so that you do not run out of time. Okay. So let's look at question number 1. Question number 1 was a capital budgeting question. As exams are moving to online exams, always be prepared for questions which might require you to think, unlike previous questions. When a paper is online, I've seen that examiners always tend to think that you are at an advantage, so they tend to really ask questions which require you to think. We are told Sunbake is one of the major players in the South African bread industry and has been active in the industry since 1990. The company is considering replacing one of its old ovens with a technologically advanced model. And then we're given details of the current oven. The current oven was purchased at a cost price of 400,000 Rand. It currently has a resale value of 80,000 Rand and a useful life of 5 years. The variable costs are 8% of total sales. The selling price per unit is 21 Rand. An output per annum of 14,000 units is anticipated, and fixed costs are 13% of the annual depreciation. And the oven was purchased 3 years ago, so this is important. The new oven will cost 600,000 and will have a useful life of 5 years, after which it will be sold at the scrap value of 50,000. So the new oven will have a useful life of 5 years, after which it will be sold at the scrap value of 50,000. right? So should the new machine be acquisitioned, there will be no damages, which amount to 10% of the current machine production. The selling price per unit will increase by 9%. Fixed and variable costs will remain the same. Both ovens are written off on a straight line basis over their 5 years useful life. The company uses the following sources of capital: book value, amount, and the before tax source of capital when evaluating investment projects. So we're given the book values of each of the investments and the specific costs. We are also given information on the changes in current assets and current liabilities, inventory, accounts payable, accounts receivable, and cash. Income and capital gains tax are taxed at 28%, and capital gains are taxed on 67% of the gain at the normal tax rate. And then we are asked to calculate the initial investment. Then we are asked to calculate the incremental and terminal cash flow associated with the acquisition of the new oven. And then lastly, based on the net present value analysis, state whether Sunbake should go ahead and replace the old oven. NB, use book values to calculate the weighted average cost of capital. Right, so the first thing we're going to look at is calculating the initial investment of the new oven. So as you know, our template for calculating the initial investment is the installed cost of the new asset. And then we add the after-tax proceeds from the sale of the existing asset, right? And then we add or subtract the change in net working capital. So for the exam, please make sure you are comfortable with this template. We take the installed cost of the new asset, we add the after-tax proceeds from the sale of the existing asset, and then it's plus or minus the change in net working capital. So it will depend whether the net working capital has increased or decreased. So let's go through calculating the installed cost of the new asset, the after-tax proceeds from the sale of the existing asset, and the change in net working capital. We'll look at those individually. Okay, so I was saying we would have to then factor in all these items to then calculate the initial investment. So let's look at each of those. So we start with the installed cost of the new asset. The installed cost of the new asset is always usually the easiest to calculate. As you can see, we've been told that the new asset has a cost price of 600,000. So this is how much is going to be paid for the purchase of the new oven, the new asset. So what you need to do, as soon as you've noticed the 600,000, you then just have to quickly check to see if there are any delivery expenses or installation expenses. And from what I can see here, there's nothing associated with depreciation or there's nothing associated with installation or transportation. So it means we're just dealing with an installed cost of the new asset of 600,000. Then after that, we have to calculate the after-tax proceeds from the sale of the existing asset. We need to calculate the after-tax proceeds from the sale of the existing asset. To get the after-tax proceeds from the sale of the existing asset, if you remember, we said that we need to use the following template, right? The formula for the after-tax proceeds from the sale of the existing asset, we simply take the market value of the existing asset and then we add or subtract tax. If the existing asset has a market value which is less than the book value, it means we are selling the asset at a loss, right? If the market value is less than the book value, we're selling the asset at a loss. This means we get a tax benefit. So we would add the tax expense, okay? However, if the market value is more than the book value, it means we are selling the asset at a profit. So we would then subtract tax. We would have a tax expense. So in this case, we haven't been given the book value. We haven't been given the book value. We were just given the market value of the existing asset. We were told the existing asset can be sold for 80,000 Rand. But we need to compare this, this resale value with the current book value of the asset to see if it's sold at a profit or at a loss. Okay. So the first thing we need to do, we need to calculate the book value of the existing asset. So to get the book value of the existing asset, we take the installed cost of the existing asset. How much did we pay for when we initially bought the existing asset? And then we subtract the accumulated depreciation. So we take the installed cost of the existing asset and then we subtract the accumulated depreciation. So as we can see, the installed cost of the existing asset is 400,000. This is how much the existing asset was initially bought for. You quickly check to see if there's anything to do with delivery or installation associated with the existing asset, and there doesn't appear to be anything, right? So this is the installed cost of the existing asset. And then our accumulated depreciation. To get the accumulated depreciation, you take the installed cost of the existing asset divided by the life years of the existing asset. In this case, the life years of the existing asset is 5 years, right? The life years of the existing asset is 5 years. So this calculation right here of 400,000 divided by 5 is giving us the depreciation per year. It's giving us the depreciation per year of the existing asset. So we say 400,000 over 5, installed cost of the existing asset divided by the life years of the existing asset times the age of the existing asset. So we were told that the existing asset was purchased 3 years ago. It's a 3-year asset, right? So this existing asset was purchased 3 years ago. It's got a useful life of 5 years and it was purchased 3 years ago. So to get the accumulated depreciation, we take the cost price divided by the useful life years multiplied by when the asset was purchased, which is 3 years ago. Okay, so if we do that calculation, we get the book value of the existing asset, which is 160,000. And then once we get the book value of the existing asset, we can then calculate the tax expense or the tax gain. Clearly, we can see that the market value of 80,000, the resale value of 80,000, is less than the book value of 160,000. So it means this asset is being sold at a loss. So because the asset is being sold at a loss, it means that we are going to get a tax benefit. So we take the market value of the existing asset minus the book value of the existing asset, 80,000 minus 160,000. We multiply that by 28%, which is the tax rate. But then there's something important we were told. We were told that capital gains are taxed on 67% of the gain at the normal tax rate. So it means that this capital gain, the difference between the market value and the book value, we are just going to be taxed on 67% of that amount. So as you can see, I then multiplied the 80,000 minus 160,000 times 28%. I multiplied it by 67% because only 67% of this gain is going to be used for tax purposes. It's like a tax allowance. And then we get minus 15,008. So since the market value is less than the book value, it means the asset is sold at a loss, so we get a tax benefit. Therefore, we add that tax amount. So we take the market value of the existing asset and then we add the 15,008, and then that gives us 95,008. Okay, gives us 95,008. Right, and then lastly, the change in net working capital. So remember, when a new asset is purchased, some amount of money is spent usually to finance the net working capital. So in this case, The change in net working capital, we simply take the change in current assets minus the change in current liabilities. So in this particular example, our change in current assets was 125,000. It's 40,000 plus, so that's inventory, it's a current asset, plus 70,000. This is another current asset, giving us 120 plus 5,000. So it's 125. So our current assets went up because there are plus signs here. These are all plus signs. So it's plus 50 plus 70 plus 5, giving us plus 125. And then our current liabilities also went up by 40,000 because it's plus 40,000 here for the accounts payable. So then we put minus 40,000. So it's minus the change in current liabilities, which is 40,000. And then if we subtract those two, we get the change in net working capital, which is 85,000. Okay. So that was how we got the net working capital. And then once we have all those values, we can substitute them into the template for the initial investment. We take the installed cost of the new asset. We add the after-tax proceeds from the sale of the existing asset, and then we subtract the change in net working capital. So remember, we subtract the change in net working capital in this particular case because the change in net working capital is a positive. And remember, a positive change in net working capital means that money went out of the company. So 85,000 Rand went out of the company for purchasing the working capital. Okay. So that then gives us the initial investment of 589,992. Remember, the installed cost of the new asset is put as a negative because it's an investment. The after-tax proceeds from the sale of the existing asset is added because it's money coming in, and then the change in net working capital is subtracted because money is going out as a result of investing in the working capital. The next part of the question asks you to calculate the incremental and terminal cash flow associated with the acquisition of the new oven. Calculate the incremental and terminal cash flow. Calculate the incremental and terminal cash flow associated with the acquisition of the new oven. The best way to do this is to create a table. And the way this table is going to work is that in this column, we are going to put the cash flows that are going to result from the purchase of this new machine. And the new machine has a life of 5 years. So in this column, we are going to put the cash flows from 1 year for the first 5 years, right? Based on the new machine. These will be the cash flows associated with the new machine. And then for the current machine, we'll just look at the first year cash flow. I've looked at a past memo from that, and a past assignment memo. I think it was in 2020 semester 1, assignment 1, and this is the approach that they used. Some students would opt for putting these cash flows year by year, but that would be a lot of work. So even in 2019, a similar question came, 2019 semester 1 in the exam. The idea is you just want to get the year 1 income statement showing the operating cash flow for the current machine, and then you also get the year 1 cash flows income statement for the new machine, even though we know the new machine will operate from 1 year to 5, and the depreciation expense will be the same from 1 year to 5, as well as the sales and so forth. But don't worry about that. Usually, if it's going to be over a number of years, for example, there was something similar. Let me just see if I can put it up. There was something similar in assignment 2. In assignment 2, assignment 1, sorry, 2020 semester 2. Assignment 1, 2020 semester 2, whereby you had to get operating cash flows for a number of years, right? But in this case, we're doing something slightly different. We're just looking at the current machine. We look at the current machine, the income statement to get the operating cash flow for the current machine. And then we also look at the new machine to get the income statement to give us the operating cash flow for the new machine. And then we know that this new machine is going to last over 5 years. So the increment that we get from the current machine to the new machine, that incremental cash flow will operate over the next 5 years over the life of the new machine. Okay, so let's start with the current machine. So with the current machine, we were told, so I just want to show you where some of these calculations are coming from to avoid confusion. For the current machine, we were told that the selling price is 21,000 and the output is 14,000 units, right? And the output is 14,000 units. So it's 21,000, sorry, it's 21 Rand multiplied by 14,000. And then if we say 21 times 14,000, we get 294,000, right? So these are the sales for the first year, the first year for the current machine. Currently it's 294. And then the variable costs amount to 8% of sales. The variable costs amount to 8% of sales. So we simply say 8% of 294. We simply say 8% of 294. And if we take 8% of 294, we get 23,520. And then after that, we subtract the revenue minus the variable cost and we get the gross profit. We've been given the fixed expenses. We've been told that the fixed expenses will amount to 13% of the annual depreciation, right? So the fixed expenses will amount to 13% of the annual depreciation. So our annual depreciation on the current asset is 80,000, right? Because we were told that the current asset was purchased at a cost price of 40,000 Rand and it's depreciated over 5 years. So it means the depreciation per year is 400,000. It's 400,000 divided by 5. 400,000 divided by 5, which gives us 80,000. So the depreciation per year is 80,000. And this 80,000, if we multiply it by 13%, we say 80,000 times 13%, we get 10,400. So that's how we got the fixed cost and the depreciation. And then we can subtract those two from the gross profit. So if we subtract the fixed cost and the depreciation, we get the earnings before interest and tax. And then the tax is 28%. So we find 28% of our EBIT. And then always make sure to check your EBIT carefully. If your EBIT is positive, it means you get a tax expense. If it's negative, you get a tax benefit, so you would add. So we subtract 28% of 180,080. And then if we subtract that, we get 129,657.60, which is the net operating profit after tax. And then we add back this depreciation expense to give us the operating cash flow. So those were the calculations for the current machine. We would then use the same approach for the new oven, but for the new oven, it would be slightly different. They changed things a bit. The lecturers wanted you to think a bit, so there was some thought here. So we were told that should the new machine be acquisitioned, no damages which amount to 10% of the current production. There will be no damages which amount to 10% of the current machine production. Okay, so currently there are damages. By using the current machine, there are damages which the company is incurring. Okay, so to account for these damages, Currently, the company is producing 40,000 units. This is the current number of units being produced. So if the new machine is purchased, right, this 14,000 is going to increase by 10% because we've been told currently we have damages which amount to 10% of the current output. So it means by purchasing the new machine, the output is going to go up by 1,400, which is 10% of this 14,000. So if we say 14,000 plus 1,400, we get 15,400. So this is the new output. As a result of purchasing the new machine, this will be the new output. And then the selling price of 21 Rand is going to increase by 9%. And remember, if we want to increase any amount by a certain percentage, we can just take that amount multiplied by 1 plus the percentage increase. Okay, so it would be 21 multiplied by 1 plus the percentage increase, and we get 22.89. So this would be the new selling price. And then we multiply 22.89 times 15,400. We take the sales, the units in sales times the selling price, and then we get 352,506. So that's where this 352,506 came from. And then the variable cost will just be 8% of that amount. 8% of 352,506 is 28,200.48. We get the gross profit. We subtract the fixed costs. The fixed costs amount to 13% of the annual depreciation. This is our annual depreciation. Remember, the installed cost of the new asset is 600,000. And we divide it over 5 years, the useful life years, to give us the depreciation per year. So the depreciation per year is 120. And then 13% of 120,000 gives us 15,600, which is the fixed cost. Okay. So you then take your gross profit minus the fixed cost minus depreciation. You get your EBIT. Always carefully check to see if your EBIT is positive or negative. In this case, our EBIT is positive, so we have a tax expense. So we say 28% of the EBIT. And then if we subtract that, we get the net operating profit after tax. And then we add back the depreciation, and then we get our operating cash flow. So the incremental cash flow that will result will be the difference between the cash flow from the new oven, the new machine, minus the operating cash flow from the existing oven, and we get 46,210.37. So this is our incremental cash flow. Okay. And then lastly, we need the terminal cash flow. The terminal cash flow template says the after-tax proceeds from the sale of the new asset at the end of its life, plus the recovery of that working capital that was used initially in the purchase of the new machine. So if we go to our case study, we are told that the new machine will be sold for 50,000 Rand at the end of its life. However, that 50,000 Rand is a market value, and the market value that we get there, we need to pay tax on that market value, right? Because at the end of its life, the new asset will have a book value of 0. The new asset at the end of its life will always have a book value of 0. And then the market value, we can sell that asset for 50,000 Rand, right? So because the market value is more than the book value, it means we are selling this asset at a profit. We're selling it at a profit, okay? So we can calculate our tax. Our tax expense will simply be the market value minus the book value times 28% times the 67% capital gains allowance. We were told we only pay 67% on the benefit. So this year, the calculation that I put there, given by 50,000, times 67% times 28%, which is 9,380, represents the tax expense. And then we take the market price of the new asset at the end of its life minus the tax expense, and then we get 40,620 as the after-tax proceeds from the sale of the new asset at the end of its life. So that's where that value came from. And then we can substitute that amount into our template, the after-tax proceeds from the sale of the new asset at the end of its life. Then always remember the recovery of net working capital. If initially we spent net working capital, when our current assets increased, you see this is a negative, we spent net working capital, it means that for our terminal cash flow, that net working capital will come back as a positive. So you see we added. However, if we had actually had a change in net working capital, which resulted in money coming in, meaning that we had more, the change in current liabilities was more than the change in current assets, then this amount would have been a positive, meaning cash came in to reduce the initial investment. And then if cash came in for that first calculation, it would mean that when we now get to the terminal cash flow, we would say cash goes out. This would be a negative. So for the terminal cash flow, with regards to the net working capital, you just make an opposite adjustment from the adjustment that you made for the initial investment. Remember, investment in net working capital is given by the change in current assets minus the change in current liabilities. It's given by the change in current assets minus the change in current liabilities. If the change is positive, it means money went out. That's when we're calculating the initial investment. If the change is negative, it means money came in, right? That's when we're calculating the initial investment. And then after doing our calculation for the initial investment, depending on whether cash came in or came out, when we are now doing the terminal cash flow, we just need to make an opposite adjustment. Either we're recovering our net working capital if money went out initially, or we are using money if we had a saving initially, okay, right. Then the next part, so that was the terminal cash flow. The last part of the question asks you to decide whether or not you should invest in this new machine, whether or not you should replace the old machine. Now, an important thing to note here with regards to whether or not you should replace the old machine, you need the weighted average cost of capital. The work is given by this formula, the weight of debt times the cost of debt before tax multiplied by 1 minus the tax rate, plus the weight of preference shares times the cost of preference shares, plus the weight of equity times the cost of equity. So in this particular case, what I did, you see these, we are supposed to use these as weights, these ones, right? We're supposed to calculate the weight of debt, the weight of preference shares, and the weight of ordinary shares, okay? So the weight of debt, for the weight of debt, we take the book value of debt. We were told to use book value. Sometimes you're told to use market values. And then we divide the book value of long-term debt divided by the total book value of all the assets. If we simplify this, we get 1/7. And 1/7 can also be written as 0.1429, right? We use the same approach for preference shares, the weight of preference shares. We say 200,000 over 700,000. This can be simplified to 2/7. 2 divided by 7 is 0.2857. 0.2857. We do the same for the weight of ordinary shares. It's 400,000 over 700,000, which is 4/7. 4 divided by 7 gives us 0.5714. 0.5714. But I just left the weights as fractions. It's up to you how you want to use those weights. If you want to get decimals, it's also fine. And then you substitute your weight times cost. The cost of debt was given in the question is 9.5%. It was given, I think, right here. I can quickly find that for you. There it is in the table. So this is the cost of debt before tax. Always check to see if you're given cost before tax or after tax. If it was after tax, there wouldn't be a need for any correction. The cost of preference shares is 12.3. The cost of ordinary shares is 15.6, right? So you then substitute into your formula and you get your weighted average cost of capital. Then finally, you can calculate your NPV. Take your initial investment as CF0. There we go. CF1, 46,210.37, 46,210.37, CF2, CF3, CF4. These are the incremental cash flows for the first 4 years. For the 5th year, remember to take the final incremental cash flow and then you add the terminal cash flow. In this case, our terminal cash flow is 125,620. And then you can use your financial calculator to calculate your NPV. So unfortunately, in this case, we get a negative NPV. We get minus 362,114.36. So since the NPV is negative, they should not replace the old AVE. Okay. So that was question number 1 in the paper, May, June 2020, question number 1. You need to practice a lot of these capital budgeting questions just so you become familiar with them. The more familiar you become with these questions, the better it will help you in terms of being able to answer them in the exam. But as I was saying, let's say you saw this question as your number 1 question in May, June 2019, and you weren't sure about it. Don't waste time and start trying to calculate it and so forth. Just move on to the most simple questions that you know. Answer everything you know. When you've got marks from what you know, then you can come back to this particular question. The next question was more of a simple one. Question number 2, it was simply a question on determining the cost of capital. It said ShopRite Holding Limited is the largest supermarket retailer on the African continent with more than 2,934 outlets. The company intends to raise 30 million to purchase a fleet of trucks to transport goods from various stores. The company will finance the fleet of trucks as follows. We're given debt 30%. The company will sell 5-year, 8% paid quarterly coupon bonds, each with a par value of 1,000 Rand. The cost that could be sold at a premium of 50 Rand, right? With a flotation cost of 2.5% per bond. Ordinary shares, the firm's ordinary shares are currently selling for 50 Rand per share. The dividend is expected to be paid at the end of the coming year at 4 Rand. Its dividend payments per share in each of the past 5 years are shown in the table below. It is expected to attract buyers. New ordinary shares must be underpriced by 10% per share, and the firm must also pay a 3 Rand per share in flotation costs. And then preference shares, ShopRite Holding will finance the rest of the money by issuing 12% preference shares that are expected to sell for a par value of 75 Rand per share. The cost of issuing and selling the shares is expected to be 7%. So calculate the company's component of cost of capital and then determine the weighted average cost of capital. Okay. Now for the cost of debt, remember you need to use your financial calculator and you calculate the yield to maturity. Always make sure your financial calculator is on the right settings, right? 1 PYR if you use the HP calculator. Be careful with that. So because we're dealing with quarterly, it means we say 5 years times 4 and then we press N. Our coupon payments, it's an 8% coupon rate times the par value divided by 4, giving us 20 as the PMT. The par value is 1,000, that's the future value. And then the PV, the price, the proceeds. We take the par value and then we add the premium. If it was a discount, we would subtract it, but here they changed in this paper. They said that we had a premium. Sometimes you have a discount, but in this paper, we have a premium of 50 Rand. So we add 50 Rand, and then we subtract 2.5. Sorry, this should say 2.5%. There should be a percentage sign here. We subtract 2.5% of the value of the bond, of the value of the par value of the bond. So it's 1,000 plus 50 minus 2.5% of 1,000, giving us 1,025 as the present value, as the proceeds. And remember, we put that as a negative. And then we press the interest button on our financial calculator. We get 1.85. And then we multiply that by 4 so that we get the cost of debt as an annual amount. And then we adjust that for tax. We multiply it by 1 minus the tax rate, giving us 5.33%. So that's the after-tax cost of debt. For the cost of equity, remember, to get the cost of equity, we can use the capital asset pricing model, or we can also use the Gordon growth model. So in this case, given the dividends and the current price of the share and the growth rates we have to get, we use the Gordon growth model. But if we were given beta, risk-free rates, the return on the market, we would use the capital asset pricing model, right? So we first have to get our growth rate. We use these dividends given right here to get our growth rate. 2.85 will be the present value because it's the earliest dividend. 4 will be the number of years. If we say 2020 minus 2016 is 4 years. 1, 2, 3, 4. So 4 is N. 3.75 is the most recent dividend from 2020. So we say 3.75, there is our future value. Then I over YR, interest per year, gives us 7.10%. So this is the growth rate. So once we have the growth rate, we can take our expected dividend of 4. We can take our price of 50, and then we can add the growth rate. So here I was determining the cost of existing ordinary shares, 15.10%. This is the cost of existing ordinary shares. So remember, if we determine the cost of existing ordinary shares, we just take the price of the share as it is. However, whenever you're dealing with the cost of equity in the exam, always calculate the cost of existing equity, which is the cost of retained earnings, as well as the cost of new equity. For the cost of new equity, we need to calculate the net proceeds. And remember, to calculate the net proceeds, we take the current price of our ordinary share, and then we subtract any issuing expenses, and we also subtract any flotation expenses. So we're told it is expected that to attract new buyers, new ordinary shares must be underpriced by 10% per share, and the firm must also pay 3 Rand per share in flotation costs. So it means the net proceeds from the issuing of these new shares are going to be the current 50 Rand, right? That's the current price minus 10% minus 50, which is for underpricing, minus 5 Rand, and minus 3 Rand, which is for flotation. So that will give us 42 Rand. And then we take our dividend of 4 over the net proceeds plus the growth rate. So this is the cost of new ordinary shares, whereas 15.10 is the cost of existing ordinary shares. And then lastly, the cost of preference shares, we just take our dividend over the net proceeds. Our dividend is 12% multiplied by the par value. It's a 12% preference share with a par value of 75. So that gives us a dividend of 9 Rand. And then the net proceeds, we take the par value minus the flotation cost, the cost of issuing the shares, which is 7% of the par value. We get 69.7. If we divide that dividend by the net proceeds, we get 12.90, Okay, so those are the calculations for the component costs for all the sources of capital. And then lastly, for the weighted average cost of capital, we were just told to calculate the weighted average cost of capital, but we were not told whether to calculate it above the breakpoint of equity or below the breakpoint of equity. Remember, if we are above the breakpoint of equity, we use the cost of new ordinary shares in our WACC calculation. But if we are below the breakpoint of equity, we use the existing cost of equity in our WACC calculation. And then the weights, and the weights are given. We are told 30% debt, 55% ordinary shares, and that leaves 15% preference shares because our weights always add up to 100, right? So that's where we got that 0.15. So it's 0.3 for debt times the after-tax cost of debt plus 0.15 for preference shares times the cost of preference shares, 0.55 for ordinary shares times the cost of new ordinary shares, giving us a WACC of 12.68% if we are above the breakpoint of equity. And then below the breakpoint of equity, we take the weight of debt multiplied by the cost of debt, like just similar to everything we did before, but the only difference now is we would now use the cost of existing equity, okay, giving us 11.84. So always check for that. That's really important. Always check to see if you've been asked to calculate WACC above the breakpoint of equity or below the breakpoint of equity. If they haven't said anything in particular, just do both calculations as illustrated in this memo that I did. Okay, so that's very important. So that brings the first part of the revision of the 2020 paper to an end. I hope it's been helpful. So I'm going to continue with part 2 in the next class. Any questions or query with regards to part 1, feel free to let me know. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you very much.